I'm Bridget Stomberg.
And I'm Lisa D. Simone.
And this is Taxes for the Masses.
Today's episode is on the interactions of two tax provisions, the corporate alternative minimum tax and the restoration of immediate R&D expensing.
In 2022, Congress enacted the Corporate Alternative Minimum Tax, or CAMT, in an attempt to ensure that the largest U.S. multinational corporations pay their, quote, fair share of tax. In 2025, Congress restored immediate expensing of research and development costs. These two provisions are interacting in some possibly unintended ways and causing substantial tax bills for some big companies like Meta. In today's episode, we discuss the perfect legislative storm that created this predicament.
Hello, B.
Hello, Lisa.
Just when you thought it was safe to start listening to our podcast again, we're talking about the corporate alternative minimum tax again.
Good old CAMT. Hate the acronym.
Yeah.
We talked about this provision a lot when it was proposed and when it was first introduced as part of the Inflation Reduction Act of 2022. We didn't love it then. We don't love it now. At least I don't love it now. How are you feeling?
Oh, yeah. No, I hate it.
Okay.
Yeah.
Would you like a little bit of pod trivia?
Yes, please.
So the first time that we talked about this, we called it A Perfect Storm.
Okay.
And then we started talking about the movie, A Perfect Storm.
Okay.
And then when I wrote the intro to this, I called it A Perfect Storm again.
Okay.
So
I'm sensing a pattern here.
I think that this is just, CAMT is it's The Perfect Storm, but it's the book. No, CAMT is the movie version, not the book, because the movie was worse than the book.
Okay. I can't remember if I ever watched that. Maybe it's
George
probably
Clooney, Mark Wahlberg.
Sure.
Okay.
On a boat that gets swallowed. I think I watched it.
Yes.
It's terrifying.
It was not good. Mm-mm. Book was great.
Okay. Moving on.
Yes.
Today we're going to try to do a few things. First, we're going to get everyone up to speed on what the CAMT is. Second, we'll talk about what sordid history of immediate R&D expensing we have here. And then we'll wrap up with a discussion of how these two tax provisions found themselves intersecting in some, I'm going to say, perverse ways.
I think that's accurate. Okay, so first up, what is the CAMT? It is actually pretty straightforward in theory.
Okay, sure.
This law was Congress's way in 2022 of forcing large companies that report a whole lot of profit to their shareholders in the form of U.S. GAAP income to pay, you guessed it, a minimum amount of tax. 15% to be exact.
Yes, and as you said, it applies only to large companies, those with average income of $1 billion or more over a 3-year period. And so, I mean, you described it pretty simply. It's simple in theory. Mm-hmm. In practice, it's not so simple.
Not remotely. And you may be asking, why not? And let me tell you why not. Because saying companies must pay 15% sounds nice and easy, but question number one is 15% of what?
Yes.
And the answer is 15% not of their financial statement income, but of their adjusted financial statement income.
And those of you who are sitting there thinking, wait a second, financial statement income isn't even the same thing as taxable income.
No.
Yeah, you're right. Yep. That is correct. And that's the first challenge with this rule. It requires a company to start with the book income they report to investors based on GAAP, which is what we call book income. And then, because we can't just leave good enough alone, we have to make a series of adjustments to this number to get to adjusted financial statement income.
And why can't we just leave good enough alone? Well, because the Internal Revenue Code, which computes taxable income, and GAAP are actually trying to accomplish two totally different things.
Totally different things.
For example, the Internal Revenue Code often allows accelerated depreciation or maybe even immediate expensing altogether for tax purposes to stimulate investment and economic growth. But for U.S. GAAP purposes, depreciation is often straight line, trying to match the revenue and the expenses. So if we didn't adjust book income to allow for some very logical and well-meaning tax incentives, like accelerated depreciation, which I don't think anybody's complaining about, then Congress would be essentially undermining their ability to shape corporate behavior through the tax code.
Exactly. So a company computes its regular tax using its taxable income computed under the full set of tax rules times 21%, less credits. Then it computes its adjusted financial statement income, or AFSI. AFSI?
No, God, I hope not.
I hope not either.
Jeez.
I don't know. And that only allows some provisions of the tax law to be included and multiplies that by 15%. And then the company examines the regular tax computation at 21%, the alternative minimum tax computation at 15%, and pays whichever one is higher. Easy peasy.
I fell asleep for a minute there. Example, please.
Trust me, so did I.
Okay.
All right, let's say a company has $1 billion of book income that it reports to shareholders.
Got it.
Because of differences between book and taxable income computations, it reports only $600 million of taxable income to the IRS. And that's totally normal, and there's nothing wrong with that.
No.
Perfectly legal, perfectly as intended under the rules of book versus tax income computations. Okay. Its regular tax liability would be $126 million, $600 million at 21%.
Got it.
Let's hope you did your math right.
I think I did. I'm double checking and it looks good. It checks out.
Assuming no adjustments to its book income, its minimum tax liability would be $150 million, 15% of $1 billion. The company would have to pay the greater of the two, so it would pay the $150 million.
Okay, so regular tax liability is $126 million. Under the CAMT calculation, you owe $150 million, so you have to pay that $24 million difference. Got it?
Yep.
Now, I also seem to remember something about a CAMT credit carry forward.
Ooh, well done.
Talk to us about that.
Yeah, so because of the many differences between alternative financial statement income and taxable income relate to timing, there's a credit. Any minimum tax paid carries forward and can be used to offset the company's regular tax liability in future years when the regular tax is larger than the CAMT. And this is very similar to how the alternative minimum tax works for individuals.
Absolutely. I love taxes.
Okay.
I love financial statements.
Yep.
But I'm exhausted.
So am I.
So as we often ask, how much tax revenue was all of this supposed to generate? Is it worth it?
Excellent question. The revised estimate was $222 billion over 10 years, coming from only a handful of firms. Some estimate that only about 80 firms are affected by the CAMT. The thing is, the calculation is so complex that the IRS was waiving some penalties for companies that failed to make estimated CAMT payments. So it's not clear whether even that lower estimate is going to be reached.
Love it. Okay, so we're up to speed on CAMT. Now I would like you to tell me what any of this has to do with OB3 and R&D and why everything rhymes.
There's so many acronyms, it's kind of disgusting. All right, we got to get back on our time machines, go back in time before the Inflation Reduction Act to the Tax Cuts and Jobs Act.
No, I don't want to.
Okay, sorry. Our listeners might remember the Tax Cuts and Jobs Act introduced a provision that required companies to capitalize and amortize their domestic research deductions over 5 years instead of immediately expensing them as they had been allowed to do previously.
And that was generally considered by everybody to be a terrible idea.
Yes.
That was going to hurt domestic investment in R&D.
Yes.
So lobbying started almost immediately to bring back immediate expensing. Mm-hmm. And Congress did, in fact, reinstate immediate R&D expensing as part of OB3.
Okay, I need a timeline and an adult beverage.
Okay, agreed. So let's do this very meticulously. 2017, the Tax Cuts and Jobs Act is enacted, and for budgetary reasons, requires companies to start capitalizing and amortizing domestic R&D over 5 years beginning in 2022.
Okay.
Also in 2022, the Inflation Reduction Act is enacted and introduces the CAMT, which does not require companies to make an adjustment for R&D expenses to their financial statement income.
Okay.
So there's no problem for CAMT purposes because book income would generally be less than taxable income for a company with a lot of R&D expenses. All else equal, they are fully expensing R&D in their books, but taking only 1/5 of that amount, roughly, in their taxable income.
Okay, let's put some numbers on this.
Please.
Let's go back to a company that has $1 billion in sales now.
Yep.
And $30 million of R&D.
Okay.
Ignoring everything else.
Please.
Alternative financial statement income is the $1 billion of sales less the $30 million of R&D, so $970 million. 15% of that for the CAMT tax calculation is $145.5 million. Taxable income is $994 million because they only get to deduct a fifth of the $30 million of R&D in that first year, so only deducting $6 million. The regular tax on that at 21% is $209 million. $209 million is greater than the $145.5 million CAMT, so CAMT does not apply.
And that is the world we lived in from 2022 through 2024. Now it's 2025, or then it was 2025, and OB3 passes. Okay. Not only did it restore immediate expensing of new R&D, it also allows companies, large and small, to expense all of their unamortized R&D from that time period in 2025, or ratably over 2025 and 2026.
Okay, so we're allowing them to now not amortize it over 5 years. They get to take it basically all at once.
Correct.
The back.
Yes.
It's looking back at, oh, wow.
Yes. So not only does new R&D get immediately expensed, we get to immediately write off everything that was hung up and unamortized from 2022 through 2024.
My head hurts.
Okay, stay with me. So our company with $30 million of R&D in 2022 has taken 3 years of that amortization for tax purposes by the end of 2024.
My head hurts.
$6 million in 22, $6 million in 23, $6 million in 24. That means that they have $12 million of R&D that they have not yet expensed. If they choose, they can just add that to their regular new R&D deductions in 2025 and really reduce their taxable income.
Okay, and that might drive taxable income to be so low relative to alternative financial statement income that now they have a CAMT tax obligation.
You got it.
My head hurts.
It should, because think about it now from a policy perspective.
Yeah, CAMT is basically defeating the purpose of allowing companies to catch up on expensing unamortized R&D from 2022 to 2024. Whose idea was this?
Nobody's.
Oh, dear.
But that's precisely what has happened to some large tech R&D intensive companies in late 2025. So Meta took a massive one-time tax charge of almost $16 billion in Q3 of 2025, tied directly to the interaction between the R&D law and the CAMT. The charge sent their stock reeling and caused them to miss analyst estimates, which is never a good thing.
No. With the charge, their earnings per share was only $1.05, but without the charge, it would have been $7.25.
Yeah.
It would have beat analyst estimates.
Yes.
So I guess thank goodness for non-GAAP earnings.
100%. Rohit Kumar, who is co-leader of PwC's national tax practice, was quoted by the New York Times as saying that, quote, the CAMT clawback is defeating the intent of Congress, unquote, with respect to the R&D catch-up. He noted that he has talked to about 100 large companies, and none of them are going to opt to accelerate their research deductions from 2022 to 2024 because it might throw them into CAMT.
Jeez. Okay, and just to be clear, it's not just the R&D expensing that's causing problems. Large tax deductions for stock-based compensation and for foreign export sales, things that are totally 100% perfectly legal.
Yep.
And they're causing big multinational corporations, particularly tech and pharma, to find themselves paying the corporate alternative minimum tax.
Yes, and I think to your question of who did this, nobody, because this is what happens when we pass 3 major tax pieces of tax legislation by 2 different parties in an 8-year time period. Nobody's paying attention to the details.
It's terrible.
It's awful.
Time for the good, the bad, and the ugly, and you're up.
I'll take it because this was like the nerd Christmas for me.
Oh God, yes, yeah.
Because this is about as deep in the weeds between the intersection of tax and financial accounting as you can get, and I that's my happy place.
Okay.
So it took me a little bit to figure out the intricacies and what was happening here, but once I did, I was in nerd heaven.
I'm glad you're happy.
Thank you.
You are the one.
I am.
Who's happy with all of this.
And that's, yes, love it.
Because this is a shit show.
I didn't say that it wasn't a shit show.
Okay.
It's just, I'm here for it, I guess is what I'm saying.
You love this particular
I
shitstorm.
It's the, accident on the side of the highway that you can't
help
ignore.
But
yes.
Look, yeah.
Yes. And that's it. There's literally nothing else good about any of this.
Yeah. So bad.
Yes.
This is super freaking complicated.
Yes. And, you know, Meta is the one that took the hit. I think Broadcom announced it. These are not small mom and pop companies who like aren't paying lots of money to tax experts and tax advisors. Like, and even they, you know, the way that the stories make it read, they didn't change their guidance. Like, they didn't warn against this. I don't know that they really realized the impact that all of this was going to have. I know politicians didn't, but it seems like potentially some taxpayers didn't either.
Yeah, but let's go back to those politicians. And I'm looking at both sides of the aisle here.
Oh, yeah.
What the F? Figure your shit out, people.
Just take a minute, I think, is the thing. I think the bad here clearly is that this is a blatant negative consequence of hastily crafted tax law. And I mean, you and I are not in these conversations, but I have to imagine that it's like, you know, the Dems got in there in 2022 and we're like, we're just going to do what we want to do. And we're not going to pay attention to the TCJA.
Yeah.
Like, that was a Republican thing. Like, we're going to ignore that. We're just going to do our own thing.
Oh, no, it was totally willfully ignored
Yes.
to make any technical corrections of a hastily passed Republican bill. And taxpayers are the ones who are bearing the cost of that.
And then the Republicans just did the same thing.
Well, yeah.
And, you know, so it's everybody's to blame here.
Yes.
And it's like, you just want to think that your thing is a special princess snowflake and that you don't need to take into account what somebody else you don't agree with has already done. And it just leads to convoluted policy.
Yuck.
And so that pretty much leads us really nicely into the ugly, which is that Congress in 2022 under President Biden basically wrote a law, CAMT, that nobody liked to begin with. And then that essentially laid the groundwork for OB3 to have a provision in the R&D catch-up that gets undone by that law that already existed. It's mind-numbingly stupid.
On both accounts.
Yes, on both sides.
Yeah.
And we've said this before, CAMT is not good law because it's lazy. It's just trying to say we can't fix the tax code, so we're just going to penalize people who are taking advantage of provisions that are already in the tax code. And in this case, we're also going to penalize people who are taking advantage of provisions that came after we wrote this bill.
Right.
Which is the frustrating thing. And so CAMT's doing what it set out to do. It just set out to do a stupid thing, I think.
And I think the catch-up R&D contributions set out to do a stupid thing in light of CAMT.
Yes, you're right. I have to place blame on both sides, that it doesn't help to let you expense something to get out of one tax hole and get yourself into another tax hole. It's out of the frying pan into the fire.
And why did we have to go back and retroactively say, oh no, you now get to expense everything right away? Like, why couldn't we just, most times we pass something and it's like moving forward, you take this new approach. I don't get it.
I guess the only silver lining is I think there's some special exceptions out there for small companies that wouldn't be subject to CAMT, so they're kind of safe. It's not hurting little taxpayers necessarily.
Okay.
But again, it's like CAMT is doing what it was supposed to do, which is penalize big companies, but it's penalizing them in a way that everybody thought was a bad idea to begin. It's just, it's a mess. It's a mess and I hate it, and it shouldn't be this hard.
But we can't have nice things.
Why can't we have nice things?
Because we're America, and that's the way it works.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.